So what we're going to be doing today is, first of all, we'll start off with the revision question, and then we will, or last week's question, and then we'll continue with this week's material. My name is Igor. I'm one of the lecturers here for this unit. My lecture is on Tuesday. Ali is obviously the unit chair, and his lecture is on Thursday. Raymond's lecture is today, usually between 5 and 8 p.m. So how many of you have read the case? So what we normally do is at the end of the week, we would give you a case study or a practice question, and then you would attempt that question at home, and then you will come back the following week and we'll go through the question together. How many of you have read the question? Who has read the question? There are no participation marks, right? I'm not assessing your participation in any way, but it would be good for me to know or to gauge the level of preparation for the class, because if you haven't read the question, then going through the solution is not going to be very meaningful for you. Who has read the question? I'm not asking you for a solution, I'm just asking if you've read the question. Have you read the question? You haven't read the question. Do you know what question we're talking about? You don't know what question we're talking about? Does Raymond go through the question at the start of the class, the question from last week or the prior week? So at the end of last week, well, last class, which was week 4, there was a question given to you about CEO of Sigma Pharmaceuticals and the fraud that they engaged in. Did you read that? That's my question. Yes? Okay. There's at least two people who've read it, 2 students who've read it. Anyone else? Now, it's not assessed in any way, but just the fact that you haven't read the question is an indication of you not preparing for the unit, maybe not taking it seriously, right? And, you know, I don't want to make any conclusions out of it, but I think you need to take the unit seriously. This is not the easiest unit out there. I mean, it's not the most difficult unit out there, but you certainly have to commit to it, especially if you've never done accounting before. I mean, it's for your own benefit to read the question, right? You're here to get your knowledge, not just sit there and listen to the lecturer, what the lecturer is saying. So, what was the question about? Can anyone tell me briefly what the question was about? No idea what the question is about? Maybe I can fall back on those who've read the question. Can you help me out here a little bit? Yeah, well, it's not so much about the possibility it actually happened. So it was figured out that they actually did commit fraud. Yeah, but do you remember from the case what the fraud was about? Now, the case is not that long. And I'm talking to those who haven't even read the case. It's not that long. What, is it 2 slides? Is it difficult to read 2 slides? Is it too much? I mean, these are postgraduate studies, right? These are not undergraduate studies. So do you remember what the case was about? Okay, we're getting there. How did they do it? how did they overstate profit, inventory, and because they how did they overstate income or revenue? And because they overstated income and revenue, then obviously they overstated the profit of the company for that period of time. How did they do it? We know from the question that that was the outcome of their misleading or fraudulent activities, but what did they do exactly? Which account in particular or specifically did they inflate? Inventory, right? So inventory was one of the accounts that they inflated. So essentially what happened is that they purchased drugs or inventory, in that case being a pharmaceutical company, at either they purchased them at inflated prices or they just recorded them at inflated prices. And then they did a reversal, but the way they did reversal was not right? So let's have a look. Now, when you purchase inventory, how do you record your transaction? If you purchase inventory using cash, how do you record your transaction in terms of debits and credits? What would be your debit? What would be your credit when you purchase inventory? There's no answer there. Okay? I'm just asking you the question. What would be our debit? What would be our credit when we purchase inventory using cash? We've talked about transaction analysis. We've talked about debits and credits, adjusting entries. We've done that up until now. That is a very simple question. I'm not even asking you about GST. I'm just asking you a simple double entry. Purchase an inventory using cash. How do you record it? Good. Debit, inventory, credit, cash. So let's have a look at a hypothetical example here. So that's what I prepared for this class. I thought we can go over it. So let's just assume that the actual price of inventory is $500,000. Right? Let's say it's the actual price, right? But the reported price or inflated price, artificially increased price, in other words, is $1 million. So let's just focus on this entry, right? So this entry here, this is what we discussed right then is if you purchase inventory or record inventory at inflated prices and the inflated price is $1 million, you just debit your inventory for $1 million and you credit your cash for $1 million, right? But what they then did was to reverse that transaction. So see, if you recorded an inflated prices, but the actual price is $500,000, what do? Well, you reverse the transaction, right? Let's say you purchase the computer or your laptop and you pay $3,000 for it. How do you record it? You debit your laptop, you credit $3,000 if you're paying cash with it, right? Let's say it turned out it was a mistake. The actual price for the laptop was $2,000. You go back to the store, what happens? They give you a refund. Well, in this case, you're not giving back the computer, right? But they're giving you a refund, and you adjust the value of your computer in your books because it's no longer at, $3,000. It's basically a reversal of that entry. So in your books, you would then debit cash because you got it back, and you reduce the value of the laptop in your books, right? Well, that's what they should have done. Now, if the actual value is $500,000, that the inflated price of $1 million should be reduced by $500,000. And that's how we should do it, right? We do a reversal, a clear reversal of that entry. We debit cash because we didn't actually spend that much money on it, and we credit our inventory because the value of inventory actually is not $1 million because the price is inflated. But they didn't do it. Instead, what they did, okay, they still debited cash because they wanted to get cash back into the company, but instead of crediting inventory, they credit sales revenue. right? Or at least that's my interpretation of what happened from the simplified accounting point of view. And so what happens now is you didn't credit, so here we credit in our inventory. You didn't credit your inventory, so you didn't reduce it. Inventory is now overstated. Okay, that's number one. And there is no revenue, but you credited revenue. Revenue now is overstated. So what we end up having is inventory that has been overstated, revenue that has been overstated, and as a result, profit that has been overstated. Okay? So that's the way they've done it, in a very simplified form. Okay? Now, that's from the technical point of view. If we look at the questions here, we asked, why did the CEO and the CFO falsify accounting books and provide misleading information? Identify two possible incentives. So the question is, why did they do it? Why did they engage in this fraud? Because the consequences of that, or the outcome of that, is that they got into a lot of trouble, obviously, right? There may be penalties involved, and if it's a really serious case, you can go to jail. So why do you think they would do it? And look, you don't have to specifically know about this case, Sigma Pharmaceuticals, just in general. Why do you think a CEO of a company or a CFO of a company or another senior executive would engage in this type of behavior where they would mislead the investors and provide false information about the company's performance? Why do you think they would do it? Correct. That's a very good reason, right? I mean, a CEO running a company wants to show that what he or she is doing is good. It leads to better company performance, right? Because if you don't show that, then you might lose your job, ultimately. And once you lose a job in one company, it may be difficult to find a job elsewhere, being a CEO of a company with poor performance. So they want to maintain their reputation. They want to maintain good company performance, right? Now, if the company is doing very well anyway, genuinely doing very well, they may not really have the incentives to start manipulating financial statements. But if the company is not doing very well economically, in other words, the underlying economics of the business or operations of the business are not great, then they may have an incentive to start manipulate the numbers in order to trick the market or investors or anybody else into thinking that they are actually performing better than or what the reality is, right? So the whole purpose of accounting, the ultimate purpose of accounting, is to provide users of that accounting information with data or with information that is going to help them in their decision making, right? And the only way that information is going to help them in their decision making is only when the information is relevant and reliable. Remember the two key qualitative characteristics or fundamental characteristics of accounting information: relevant and faithfully represented, right? So the problem here is that the information was not faithfully represented, hence a lot of people lost their money. Because if, let's say I want to start my own business, right? And I approach you guys. So I come here and I stand here and I say, look, my business idea is great. I want every single one of you to invest $1,000 into my business, and then we can share the profits all together. I'll run the company, you'll just have to provide the initial capital, right? And I provide you with some information. I say, look, trust me, it's going to be profitable, right? You're not necessarily going to believe me. Now, I then might provide you with financial statements. I might, on a piece of paper, produce an income statement, the balance sheet, etc., and I give it to you. Would you then believe me? If I write on a piece of paper that my company is profitable, so I put together an income statement, a balance sheet, a cash flow statement, or even projected financial statements, and I give it to you, do you believe me? Would you believe me? Would you believe me? Really? So easily. You can analyze that. But let's say on the income statement, I say that my profit is $1 million. You can analyze the numbers. Numbers look perfect. They're amazing. Do you believe me? The problem is that according to the agency theory, which is one of the most important theories in accounting and in finance, humans or individuals are utility maximizers, meaning that if I have an opportunity and an incentive and I can justify it, I'm likely to take advantage of somebody else opportunistically to generate some wealth for myself, right? To do it at a cost of somebody else. And you're likely to do it on average. I'm not saying everybody would take advantage of everybody else, but on average, that's what's going to happen. If you have an incentive, you have an opportunity, and you can justify it. So you wouldn't believe me, but if I produce financial statements, and these financial statements have been audited, and that's what you would have talked about with Raymond last week or in the last class about corporate governance, right? If you have the financial statements audited by a reputable auditor, then it gives you some, or it gives the financial statement some credibility, and now you believe me more because the auditor's reputation is at stake and all that stuff. So the question here is, why would they provide you with misleading information? And we answered that question partially, right? We said, well, they have incentives to show that they're performing better than what's actually happening. And they might have that incentive to show better performance for a couple of reasons. There could be market pressure. So financial analysts, if we're talking about a large corporation, you would often hear that the large company would be followed by a bunch of financial analysts. So these are professionals who follow companies and look at their share price, look at what's happening to the company, and basically make forecasts about what the profitability, the share price of that company is going to be in the future, right? They do some analysis of the industry, of the company, etc., etc. Let's say there are 5 analysts. They're following the company, and they all agree that the revenue of a company in the next year should be $5 million. And it just so happens that a couple of things happen along the way, or the company wasn't performing too well, and the managers cannot reach that target. They can only generate $4 million of revenue. Right? That puts a lot of pressure on them, because if you don't meet the target or the expectation of the market, you might lose your job. Investors may lose confidence in you. Right? These things are all tied together, and as a result, they may have a strong incentive to go from $4 million to $5 million to meet the market's expectation. The other reason, a very important one, is compensation. A lot of the managers, well, most top executives, would be compensated through their variable portion of the compensation, being their bonus, based on their performance. So if they generate profit that is above a certain threshold, then part of that profit can be given out to them as a bonus. So of course they would have incentives to perform better, or to show that on paper at least they're performing better, because then they can get the bonus. Okay, so let's have a look. Well, from the article we know that, kind of a bit of a backstory to it, that Sigma purchased wholesale drugs at inflated prices. Inflated payment returned to Sigma and recorded as revenue instead of a reduction in inventory, just like we looked at before. Overstated revenue, overstated profit, and part of that also was overstatement of inventory, because it wasn't actually reduced from the inflated prices to the actual price of inventory. So what are some of the possible incentives? To meet performance targets, bonuses, for example. Executive compensations are quite complex, right? It's not just about the salary. There is the cash component of the compensation, which includes the salary, which is relatively fixed across periods, but there is also a bonus, which strongly correlates with company's performance. But on top of cash compensation, there's also equity compensation. Sometimes managers are awarded shares, options in the company, because it is believed, at least, that if they hold a stake in the company through shares or options, it gives them even greater incentive to deliver better firm performance, genuine firm performance in the future. To comply with low covenants, maintain profitability, debt asset ratio, for example. So there's a chart there which says, sure, you can borrow. And what that basically means is that, let's say you're a business and you approach a bank. You have to have a very strong case for them to give you money, right? You can't just walk into the door and say, you know what, I want $100,000 right now. I'm about to start a business, right? That's not going to cut it. You have to have a pretty strong case as to why they should give you the money. And even when they give you the money, they may put in place a bunch of restrictions, and we refer to those restrictions as covenants. And what that means is that they might say, well, look, at no time during the period of lending or from the time that we've lent you the money until the time when you have to pay out the principal, at no point you can have this particular ratio go below this. At no point can you have less cash than this threshold, etc., etc., etc. And so oftentimes managers would realize that unless they manipulate some numbers here and there, they can't really meet those covenants. And the cost of breaching those covenants could be really significant. Well, first of all, you might lose the loan in the first place. Then you have to pay some penalties, and then it may be very difficult for you to get a loan from another bank, right? Because this bank might just say, well, they didn't pay us, they're not reliable. Or they breached the contract, they breached the covenant, they're not reliable. So there could be a lot of problems with that. So they may not want that to happen, so they may want to manipulate some numbers to achieve those restrictions, or to satisfy those restrictions. To meet a bid analyst earnings forecast, I talked about it just a few minutes ago, because if you're not meeting analyst earnings forecast, it can result in negative share price, which is obviously not good for the shareholders and ultimately for the managers of the company. So based on the media release, reflect on why accounting regulation is essential in financial reporting. So what are some of the benefits of regulation in financial reporting in general? So last week we talked about accounting standards, we talked about regulations, importance of regulations, we talked about enforcement of regulation and how enforcement is also important. We talked about the idea of having countries adopt international financial reporting standards because it improves comparability of the financial statements across countries and ultimately understandability of those financial, etc., etc. So can you tell me some of the benefits of regulating the financial reporting space in general? What are some of the benefits? Yeah, so it certainly boosts the trust or confidence of the investors of the whole market. That's true. Anything else? In the market, organizations, committees, bodies, etc., they exist for a reason. A lot of this is in the market not because it has to be there, originally at least anyway. It is there because there is demand for it. Look at auditing. Well, auditing now is regulated, right? But originally auditing was not required. Auditing was there because somebody at some point wanted a third party that is independent and knowledgeable to sign off or certify financial statements, right? To tell the stakeholders, the shareholders, the owners of the business that these financial statements are legitimate, right? It wasn't there because it was regulated, because it was demanded. So anything that happens in the space, it's demand and supply. If you need it, it will stay there, and participants are prepared to pay the price for it. If the market doesn't need it, it may go away unless it's heavily regulated. So the first thing, obviously, and the reason why ASIC exists, for example, in Australia, Australian Securities and Exchange and Investment Commission, is that, okay, we have these rules in place, but we have to regulate them, and we have to make sure that companies actually comply with these standards, rules, and regulations. unless we enforce it, no one is really going to be following those rules. I mean, if the rules are voluntary, then nobody's going to follow them, unless it benefits the company. But following rules and regulations often introduces costs for companies to do so, and it restricts their discretion, creativity in that sense. So it enforces compliance with accounting standards when preparing financial statements and ultimately increases the quality of that information. I mean, just following the accounting standards, standardized rules in preparing the financial statements also increases the quality of that information, right? If you tell accountants, look, you can report items whatever way you want them, you don't have to follow any standards, you can see how they can take advantage of it, right? I mean, they will report items that shouldn't be there, or they will inflate prices because there's no clear standard on it, right? So you have kind of these two opposing views. On one hand, if you make accounting standards very, very, very strict, it's good because there isn't any other way in which you can interpret the results, right? Or you can interpret the standards. You can't say, well, we can do it in A, B, or C way. There's only one way. The rules are very clear and they're very standardized, right? But there's another view that there should be some rules there, but we should give companies discretion, freedom to do or to adapt to those rules or apply those rules in a way that would better reflect the underlying economics of the business, right? There's always that debate. And that's clear in how, for example, in the US, companies account for research and development, that research and development are both expense, but in Australia, research is expense, but development can be capitalized, in other words, can be recorded as an asset. Public confidence, which we touched on as well. Increased investor efficiency, well, that comes from, I guess, the investor confidence there as well. Increased investor efficiency in allocating capital, which is what the capital markets are about, right? It's you having money and you invest in money in an efficient way, meaning that you invest in companies that you think will in fact generate profitability for you, right? So by giving companies money, you give companies your capital, cash, for them to invest in projects and expand in the future, take on new opportunities and generate even more wealth for the shareholders. So if there is a lot of transparency in the market, that allows you as an investor, provided that you understand what companies are doing, gives you a good opportunity to efficiently allocate your resources, meaning that you invest in the right companies for you as an investor. Standardization of information and reporting, and that ultimately leads to cheaper production of account information, right? If you have standards that you have to follow and the whole space is regulated, then it's a lot easier for you to actually prepare the financial statements and know what can happen if you don't do them in the right way. And another benefit of regulating financial reporting is you can basically check on whether managers are compensated fairly. So if you know that the accounting numbers are accurate, you know that the accounting numbers have been prepared accurately, they are reliable, relevant, etc., then you can see whether executives of your company are compensated fairly. If the accounting numbers are accurate and the performance of the company is not that great, but all of a sudden they're paid millions and millions of dollars, or a lot more than what the industry average is, then it raises some concerns and ultimately makes the market more efficient because you can fire those managers if they are underperforming. Any questions so far regarding this? We spent quite a bit of time on this, but hopefully that was useful. Now, what we're going to be looking at today, if I go back all the way to the topic for this week, we're looking at internal controls, cash and cash budget. So we'll spend most of the time talking about internal controls and then bank reconciliation. So that's a very big topic, and we really need to go into detail of the topic and make sure that we understand how bank reconciliations are done. Then we'll spend a little bit of time on petty cash, and we'll finish up with cash budget. So hopefully we can do the first two, internal controls and bank reconciliation, within the first 2 hours. So now an hour and a half. We'll have a 10-minute break halfway into the lecture. So until then, we need to cover internal controls and part of bank reconciliation anyway. So these are learning outcomes for this week's class. We need to outline the components of a good internal control system. Number one, explain the role of a bank reconciliation. Prepare and post journal entries related to transactions on the bank statement, and then prepare the actual bank reconciliation. Then we need to account for petty cash, but that's only a couple of slides on that. Explain the purpose of a cash budget, and then prepare a simplified version of a cash budget, right? Payments or receipts, payments, and that's it. So that's the plan for today. Let me quickly skip through this. So internal control systems and its effectiveness. So why do we have to have internal controls, and what are their benefits, or how they can be effective in running a business? And when we talk about internal controls, we're not necessarily talking about, physical protection of an asset, right? It could be, protection or internal control over the whole accounting system that is in place in the company. So internal control system consists of all measures employed by an entity to safeguard its resources against waste, fraud, or inefficiencies, promote reliability of accounting data, encourage compliance with management policies and government regulations. Right? So if you have policies and regulations, you really want to make sure that you comply with those policies, because they've been put there in place to make sure that the business is being run efficiently and effectively. In other words, not wasting resources and getting to its goal or its goals that have been set in place by the top management of the company. An effective internal control structure assists in irregularities being prevented, detected, and corrected. And really, the whole topic or the whole idea of internal controls is going to be covered in a lot more detail in auditing. So when you take auditing, you will talk about internal controls, and specifically about the use of internal controls to prevent, detect, and correct any errors or irregularities when you take on that unit in much more detail. So assets being safeguarded from unauthorized use, and financial reports and other relevant databases completely and accurately reflecting the entire operational activities of the entity, right? To allow for the timely preparation of the financial statements. In other words, the information is complete, it's not omitted in any way, it's full, reliable, relevant, etc. So let's have a look at some features of internal controls. It's led from the top, so the management actions are important. If you look at a lot of fraud cases, you realize that it's the mood or the culture that has been set by the top management, right? If the top managers are behaving in a way that is not conducive to performance or better or increased performance, or employee commitment to deliver better performance and profitability of the business, then lower level managers are not going to really follow. Or are not really going to encourage that, or not really going to be motivated and work hard for the company to achieve its goals. So it's all set from the top. The other important thing with internal controls, so for them to be effective, is to have competent employees, including adequate pay and motivation, right? If employees are not adequately paid and if they're not motivated, it can actually create incentives for them to try circumvent the controls and try to engage in some fraudulent behavior that would benefit them, to compensate them for the lack of adequate compensation, essentially. Clearly established lines of responsibility. Employees in the company, staff in companies need to be accountable for what they're doing, right? If there are no clear lines of responsibility, then you don't know who is accountable for what's happened. And that encourages perhaps risky behavior from the employees of the company and maybe even from the top management. Maintain of effective records, and what we mean by that is that you do have a record of everything that's happened, of all the transactions that happened, and the record that is reliable. And again, as you learn in auditing, the most reliable record is the one that has been generated externally. I can write, if I'm a manager, I can write an invoice to a client, but if I do it from my end, it doesn't mean that it actually happened because I can easily forge it, versus a client actually, or a customer actually sending me an invoice or a remittance advice telling me that they've made a payment. And, maintaining effective records is also useful for the auditors when they come in and they actually do their auditing work. Separation of record keeping from handling the asset. If I'm the person who handles the asset, or I'm the custodian of that asset, in other words, I have physical access to the asset, and I'm also the one who's responsible for recording the transactions, right? Then I can, let's say I can record that there was an expense, $5,000. The money went from the bank account, but there's actually no expense, and I took the money myself. All right, so there has to be a clear separation of duties. And in this specific case, handling of an asset and record keeping. Now, so when auditors come in and they do their auditing work, they will definitely look at the strength of internal controls in the company, right? Now, if internal controls are very strong, that they can rely on internal controls and do their audit. If the internal controls are weak, meaning that a lot of the transactions that have been recorded could be inaccurate, intentionally or unintentionally, they have to do a lot of checking themselves. Now, guys, you're talking at the back. What seems to be the problem? Are you here for this class, or what's happening? You've been sitting there chatting for like 10 minutes now. Is everything okay? Are you enrolled in this class? Did you come prepared? That's really not acceptable behavior. Okay, rotation of duties, right? Duties have to be rotated as well. And it's kind of linked to the fact that some employees don't take leave for a very long time, and that could be kind of a red flag for the auditors even, when they audit the financial statements of a client. Duties need to be rotated, because if the same person has been in the same position, or if the person has been in the same position for a long period of time, and another person has been in another position for a long period of time, they might have colluded by now. By colluding, they might actually overcome the separation of record keeping and handling the assets. Somebody records transaction, and somebody else handles the assets, right? If they collude because they've been in the same position, they've known each other for a long time, that can lead to that. Internal auditing might help. So even before we do the external auditing, larger companies would have internal audit teams that would help them in identifying some of the inaccuracies, mistakes in the financial statements, or in the process of preparing the collecting, recording, and then preparing the financial statements, collecting, recording the account information to prepare the financial statements later. Physical protection of sensitive assets, right? And by sensitive assets, often we mean cash, for example, if it's on hand, although these days everything is done electronically, basically. But some assets could be still physical in nature, and they could be quite valuable. If we're talking about the jewelry business, for example, they would have assets on hand, and some of those assets, could be quite valuable. They may be quite small in size, but they could be quite valuable. So physical protection of sensitive assets is important. Adequate insurance, of course, as well, right? In case something does go wrong, I mean, you can't prevent natural disasters from happening, for example. Employees have to take regular leave. I think it's related to some extent to the rotation of their duties, right? If an employee does not take regular leave, that could indicate that they may be in the middle, or they refuse to take regular leaves. They may be in the middle of perpetrating fraud. They're trying to do something, right? And therefore they refuse to leave their position because they know there will be rotation of duties, or somebody else will come in who might detect the errors or the fraud. that either has happened before or is happening right now. In addition to that, if an employee does not take regular leave for, genuinely they want to continue working, I mean, what if they are overworked and they just make more mistakes as a result of that? So that's basically, this points there to show us in what circumstances the internal controls are effective, when they actually work, what sort of features they need to have for them to be effective. So that the companies can rely on them to operate their business and prepare their financial statements, and then auditors can rely on as well later on to audit the financial statements of the company. So what are some of the limitations around internal controls? Well, management may override or collude, and resulting in them circumventing some of the controls. If we have two different employees who one has a responsibility, again, going to that example earlier of recording transaction, and another has responsibility of handling the asset, that they can collude and they can basically make certain items disappear, right? As if the asset was sold, but in fact, they took possession of the asset, or record an expense that wasn't there, and they can just misappropriate the cash that they have physical access to. Most controls are directed at routine transactions, so if a transaction is quite unique in nature, it's a one-off thing, the internal control system may not be able to pick it up. No internal control system is perfect. There could be computer or cyber fraud. The data might be lost. That's why, I guess, if we go back to the previous slide and look at the features of internal controls, we might also say that it's important to have backups of your data, right? I mark a lot of assignments, and every single trimester receive emails from students saying that I was working on the assignment, but last night my computer broke down and I lost a copy of it, right? This is very difficult to believe. It's probably that the student hasn't actually started working on the assignment and they just want an extension. You always have to have a backup copy of your assignment or whatever important documents that you might have, right? You have cloud services that are available now where it's pretty much impossible to lose that copy unless you actually go there and delete it from the cloud service. So human error, right? It could be just an unintentional human error. The human or the staff or the employee might have been careless, not understanding the instructions, and that would make the control less effective or maybe entirely ineffective. And then the other one is cost versus benefit, right? What is the benefit of implementing the control? If you know that somehow money has been stolen, if you know that somehow money has been stolen from the company, but it's only a couple $100 a year, for example, putting the control system in place that would cost you maybe $10,000 does not seem to be so feasible, right? So it's a cost versus benefit analysis that companies have to do, especially if it's a small-sized company. So the example that we already mentioned a couple of times is a separation of duties. So the cashier in a small business records the receipt of cash, banks it, and also keeps the ledger. That's really not appropriate. Recording and the custody of the asset, or any item really, should be separated. But if they collude, right, if these two responsibilities belong to two different employees and they collude, then they can obviously override that control. So let's have a look at internal controls and the disclosure requirements, just briefly. So internal controls is the responsibility of the management. Right, in early 2000s, there were a lot of frauds happening in the US, as well as Australia, but mostly in the US with the dot-com crisis. Enron was one of the largest corporate collapses in history. And after that, there was the Sarbanes-Oxley Act. You might have heard of it. That was enacted in early 2000s. And then one of the sections in the Sarbanes-Oxley Act actually required managers to report on internal controls, and I believe the auditors have to do the same thing. They now have to report on the strength or effectiveness of internal controls of the client that they're actually auditing. But ultimately, it is the responsibility of the management. Remember, we as shareholders give managers the power or discretion to generate profits from the company's operations to then distribute between the shareholders, and it's also their responsibility to make sure that the company is being run smoothly, right? One way to achieve that is to have a strong internal control system, so it is under their discretion, or it is their responsibility. So companies that are listed on the ASX, Australian Stock Exchange, are required to include a section on corporate governance, including description of their internal controls, right? So if you're listed, you have to do it. It's not uncommon. If you want to be listed on New York Stock Exchange or NASDAQ or some of the larger exchanges around the world, I'm sure they'll have their own listing rules that you have to follow, and reporting your internal controls must be one of them, right? Because if you're listed on those exchanges, you get a lot of exposure. There's a lot of capital being injected by investors into companies, and the stakes are very high. So you need to really make sure you protect the investors. One way of doing it is them establishing internal controls and reporting on the effectiveness of those controls. You're talking from the point of view of auditors? Yeah, I think I can't remember from the top of my head, I think it's section 404.
Yeah, I worked as an audit.
Okay.
Audit of internal controls, where we looked at whether the controls that have been placed in the company are not complying with the Sarbanes or not.
Okay.
The audit of internal controls.
Yeah, so it's good to hear from the first-hand experience here. So, but yeah, exactly, auditors have to go through that. Because it is an important part of the whole process of preparing the financial statement. So there were a couple of examples here that I thought were quite interesting. I didn't know about the Barings Bank. I mean, you always learn some new stuff every day, and I read a little bit more about it. But it was the second largest merchant bank, or in other words, investment bank in the world. Second largest. It was founded in 1762 in London. And it was one of the largest merchant or investment banks, founded a long, long time ago. And then Nick Leeson comes along, and he's a very, early 90s, he's a very successful investment broker or trader. He, being an investment bank, what investment banks do is they invest money in other businesses, right? In an attempt to generate abnormal returns, or returns that are higher than what the risk-free rate would be. And so he makes a couple of really profitable trades, well, not a couple, some profitable trades in the first couple of years of his employment. He's considered to be a rising star, and everybody looks up to him. But in later years, leading up to 1995, he wasn't doing that well. The trades that he was doing were not that profitable. But he didn't want anyone to know that he was not capable of, maintaining his performance from a couple of years prior. So what he did was he created the account 88888, and he would take banks' money and make trades. And any losses that he would make from those trades, he would put in that account. Any profits he would make, he would show to the bank. So the bank is looking, well, this guy is just only making profits. I think he was his trades accounted for the 10% of the profitability of the whole bank, which is amazing, right, given the size of the bank. So everybody was very happy, but then of course they discovered that in that account they had $1.3 billion worth of expenses or losses. So he, of course, I think at that time he fled the country. He was trying to escape from the whole thing, but he was imprisoned. I think they caught him first time in Singapore. He was imprisoned for 6.5 years, right? So it's a serious issue. I mean, it's fraud. He committed fraud. He basically lost $1.3 billion of someone else's money. Right? Imagine you've invested in a bank, and then the bank loses all the money. They can't pay you back, and the bank can't be bailed out, or whatever the case might be, you're losing your money. There are stakeholders that have been directly affected by this. So there's a pretty serious case. So, and of course, we no longer have the bank anymore, right? In 1995, the bank was defunct or basically was or filed for bankruptcy. Then we have NAB 2005, a currency trading scandal. There was another loss of $360 million, and there was the Royal Australian Mint. But I think that's for the next class, for you to discuss, for you to read until next class and then discuss with Raymond next Wednesday. Now, going back to Barings case, the Barings Bank case, why did that happen? How could he possibly do that? Well, there was no separation of duties. He was the one who was responsible for trading, and he was the one responsible for recording those transactions. So you make a trade, everybody trusts you, they think that you know what you're doing, and they say, well, you did the trade, you recorded, no problem. But he did the trade, he recorded himself, all the losses put on that account, but of course, at some point, somebody realized that there was a big loss accumulating in that particular account. Now, specifically going from internal controls, we're now focusing on cash. Right, you will see the theme in the unit. We started off with the general picture of financial accounting. We talked about the conceptual framework. We talked about some regulations. We talked about analyzing business transactions, using the double entry accounting system to prepare financial statements, or at least the trial balance, adjusting entries, and the adjusted trial balance. But now we're starting to look at, specifically starting to look at accounts, right? And the first place we're starting off with is cash, because you remember the table of accounts, the very first account is cash. And specifically looking at cash control. We'll be looking at other assets later, inventory, some non-current assets, revaluation methods for those assets, and we haven't even talked about depreciation yet. So we'll talk about it later on, but each week we're kind of trying to dedicate to a particular item on the financial statement. So we're looking at cash. So why is cash control important? So cash is one of the most vital assets of the business, right? Remember, we prepare financial statements based on accrual accounting, not cash accounting. Because accrual accounting is more accurate. There is no doubt about it. It's more accurate because it recognizes revenue when it's earned and records expenses when they are incurred, not when cash exchanges hands. Having said that, cash is very important, right? Because cash is being used to pay for all the expenses, to expand the business, buy non-current assets, etc., etc. So it's important to have cash. Or it's important to have enough cash for whatever activities you're trying to do. If a business is unable to collect cash from its customers, it will eventually become insolvent, irrespective of the growth. The business could be growing a lot, but if you're making your sales on credit and you are not able to collect the money back from your accounts receivables, then that's a problem, right? Because you can't work on credit all the time. You have to actually materialize that and have that as cash to pay expenses, etc. Cash is an asset that is mostly common the subject of misappropriation of fraud. I mean, I guess we will see in a minute why that is the case. Well, because it has the highest inherent risk, and the reason it does have it is because it's liquid in its physical movement, so it's very easy to transfer from one party to another, right? If I give you cash, you can just go ahead and use it right away. There are no rights attached to it. Once you have the note, you can go ahead and use it. And it's anonymous in its physical possession. What that means is that you can't really trace it back to where it's come from unless someone knows that for a fact. So if I give you a $100 note and nobody knows about it, and I don't tell anybody, then no one would ever know. So no one can actually blame and say that you've stolen the money from somewhere. It's not traceable, it's anonymous in that sense. So one way to control cash and make sure that what companies report in their cash account is actually how much cash they have in their bank account is to do your bank reconciliation. So the word reconciliation suggests that we are trying to check for the consistencies between what's actually in the bank of a company and what they report they supposedly have in their bank. So you can see that cash book balance is $1,500. The bank statement shows $1,760. The difference of $260. The question is that right? Can we reconcile the two and find where the difference is coming from, right? So that's the idea of bank reconciliation. It's a schedule that explains the differences between the bank statement, which is an external document, and from auditing you would know that that's what auditors would most likely be relying on, not the records of a company. When I taught auditing before at another place, I'm not sure if you use, there's an electronic system online where you register as an auditor, and the system includes, or other parties can register and be part of that whole network. In which case you can actually send requests to banks electronically through the system.
We send a letter, bank information letter to the banks directly without involving company.
The client, yeah.
So that we can have a third-party confirmation. So we send directly
Correct.
to the bank. This is called, I think, bank confirmation letter.
Correct.
We prepare it and send it to the bank, and then we get it. So there is no involvement of the company. So that we get third-party confirmation.
Yes. So, but the technology is evolving all the time, and yeah, and so the new way of doing this is that if you're a large auditor, that you probably would consider. I'm sure they're registered already. Yeah, exactly. So you register with the system. You have all the clients as well as banks, because the client still has to give permission to you to contact the bank. So, but when you do that, you get a confirmation coming from the bank that that's how much money the client does have in their bank account, with the permission of the client to do that. There was a case where, the auditor sent out a letter, a physical letter to a bank to ask for the confirmation. But they put in the wrong details and the letter ended up with the client. And so the client got a letter, they opened the letter, and in the letter, the auditor is saying, well, referring to the bank, tell us how much money the client has. And they put in a number that wasn't obviously right. And there was a whole scandal around that there as well. So that's an external document. The company's general ledger, cash balance, is an internal record, right? So these two have to be reconciled. There could be time and difference. We're not really working with checks anymore, but assuming that you can still write out a check. If you write out a check, you would immediately record it in your financial statements, in your ledger account, but it may take a while for the bank to clear that. Even, payments from one business to another takes a while to clear, especially if it's an overseas bank or there are multiple, or not even an overseas bank, but a different bank. Even in Australia, it may take overnight for the funds to clear. Human recording errors, that's a possibility. Customers facing financial difficulties in case of dishonored checks. Sorry? Yeah, transpositional errors. So that's, I guess, human recording errors. So we need to identify consistencies, omissions, and errors between bank statements and the bank ledger account. And once we do identify those consistencies, we need to correct them, right? So you look at the bank statement. The bank statement might have information that we don't have in our cash ledger. Our cash ledger might have information that the bank statement doesn't have. So we have to really make sure that we update the bank statement through bank reconciliation, and we update our records by the journal entry, doing the journal entry. So when you get your bank statement, you can't just go to a bank and say, look, this number is wrong, change it now, right? That's not how it works. You can update your records, but you can't really update the bank's records. The best you can do is do a bank reconciliation. Start with the bank balance, do the adjustments, and get to the number, which should be consistent with what you should have in your cash ledger account once you do the adjustments there as well. So serving as an internal control to prevent employee theft and money fraud, right? So if you do the reconciliation and you get the right balances through your bank reconciliation as well as your cash ledger account, it gives you some confidence that the money has not been misappropriated or the cash has not been misappropriated in any way. So let's have a look at the bank reconciliation and how we do that. So why might the balance according to the bank statement be different from the balance in the cash at bank ledger account? New items that appear in the bank statement only, right? So you have items that appear in the bank statement that do not appear in your cash ledger. Or in the previous class we talked about special journals, right? The cash receipt and the cash payment journal. So you have transactions in your bank statement that are not in your cash receipt or cash payment journal. Right? Bank charges, interest that might have accumulated that you didn't know about until you got your bank statement. Dishonored checks, a client might be, or you might have used a client's check, they've issued you a check, you've cleared that with the bank, you put that in the bank, the amount was recorded, but it didn't clear because the client didn't have enough or sufficient funds. That's another possibility. Or any other direct debits and credits that you might not have accounted for. Then we have items that are included in your cash journal, either your cash receipt or cash payment journal, but not included in the bank statement. Right? So you might have written out some checks, or you might have made a deposit yourself, which hasn't cleared with the bank yet. So unpresented checks or deposits that are in transit. Or another word for those are outstanding checks or outstanding deposits or uncredited deposits. Or there could be errors in either the accounting system or the bank system. Transposition errors in the cash book recording, the bank incorrectly coded items into your bank account. That's also a possibility. So do you have any questions so far? Now we're kind of moving relatively quickly through this. We'll take a little bit more time when we do go through exercises, when we look at bank reconciliation. It would certainly help if you read through the slides before the class, right? And you come somewhat prepared, at least read the slides and read the textbook chapters. So the bank reconciliation takes the following form. We call it, well, we start off with the bank balance, right? So the balance according to the bank statement, and I mean, from the bank's point of view, your money, let's say you have $2,000 in your bank account. From your point of view, if you can think of yourself as a business, that's your asset, right? That's your money. But from the bank's point of view, it's a liability. They owe you the money, right? That's why when you look at your bank statement online, when you log into through your net banking, for example, even though it's a positive balance and you do have the money, from the bank's point of view, it's a credit, right? Some echoes here. So we start off with that. What we have to do next is to update the bank statement with amounts that we do have in our cash payment and cash receipt journal, but the bank does not have in the bank statement or not reflected in your bank statement. So we need to add back deposits that are in transit or outstanding deposits that have not cleared with the bank yet, and then we have to deduct any outstanding checks that might be there. Right? For example, let's say you've written out a check to your client that they have to use with the bank to clear the funds, right? But they may not go to the bank to do that maybe for about a week. So in your records, you paid them. You've recorded the transaction, but it hasn't cleared with the bank yet, so you have to reconcile that and make sure that it's reflected or it's accounted for from the bank statement point of view. Or deduct any bank errors if there are any. And that will give us, so that's very important, it will give us the adjusted bank balance according to our general ledger account, right? So, in other words, that's how much money we're supposed to have in our cash at bank ledger account. So once we get this, plus this, minus this, add or remove any errors, this is what we get, and this is how much money we should have in our cash at bank ledger account at the end of a period. How much money we should have. If we don't have it, that means there are items on the bank statement that haven't been included in our cash payment or cash receipt journal. And you can see now, once we've done the reconciliation, we got to a debit. Because in our records, cash is an asset, positive cash balance is an asset, and it has a normal debit balance on the left-hand side. Okay. So let's update company's ledger account. So cash balance per ledger consists of the opening balance plus the cash receipts less the cash payments. We know that. for the month. We then add any receipts reported on the bank statement but not in the ledger. In this case, examples are note receivables, direct deposit, interest, a dividend, for example. Let's say you invested in a company, invested in another company, and that other company paid you a dividend, which you didn't account for. You look at your bank statement, there's a credit there, meaning that it's the liability to the bank, but it's your money, the money coming in. You didn't include it. You go back and you include that to your cash receipts. That's how you update it. Then you deduct any bank charges, any direct debits that you're not basically aware of until you get your bank statement and the errors. So it's a similar story there as well. That will give you the adjusted balance as per ledger account. Now, whatever you get here, adjusted balance as per your ledger account, whatever you get here must be the same as what you get here. So that's if you do get them and it's the same value, that means it's all reconciled. And that means that the records are consistent between the bank statement and what you have in your ledger account. But once we go through an exercise, I'm sure it will make more sense or make it easy for you to understand. So all of the above need to be recorded in the company's records, the journal entry. So when we do this, when we do bank reconciliation, you just prepare this bank reconciliation. Nothing else is adjusted. As I said before, you can't go to the bank and you can't tell them that, look, you don't have this, can you update the statements, right? They don't do it until transactions actually clear. Well, unless there is a mistake, right? But in other cases, they can't actually update any of that information, so you have to wait. That's why you prepare reconciliations every single month. But in case of the ledger account, you can actually update it, right? Remember, it's just a double entry. If you should have received more cash, debit cash, credit, wherever it's coming from. If it's a payment, then you recognize whether it's an error or an expense, and you credit your cash. You can update your financial statements to make sure that they're actually accurate. Okay, enough talking. So that's the first student task that we have for today. So in this case, now, you will see later on when we do a more complicated bank reconciliation that you need 3 documents to do your bank reconciliation. You need prior period bank reconciliation, you need your cash receipts and cash payments, and you need your bank statement with all the transactions. You need 3 documents, right? So here, you're not given 3 documents, you're just basically given all the information that is required for you to do your bank reconciliation. So I'll give you about 6 minutes until roughly around 6:15 to have a look at this question and try to attempt it yourselves. The first thing that we have to do is we have to prepare a bank reconciliation. Maybe we can just focus on that for now. So I think 6 minutes is a fair amount of time for you to try to attempt that question. So when it requires you to prepare a bank reconciliation, all you have to do really is just go back to this format. Right? Balance according to the bank statement, you have that information. Add deposits in transit, you have that information. Outstanding checks, you have that information. Any errors, you also have that information. And then once you go through that, you will get to your adjusted bank balance that you should have in your ledger account. Okay? And usually, while you're doing the question, if you have any questions and you want to ask me any questions, you have any queries, just raise your hand. I'm happy to come around and help you out. Okay, let's have a look at the solutions. Well, let's work through them together. I can see that a lot of you are using phones to do your calculations, and look, that's perfectly fine in the class, but obviously not going to be allowed in the final exam. And I suggest that you get yourself a calculator and start using the calculator to get used to it, right? You know, in the final exam, every minute makes a difference, and if you get used to your calculator now, that would make a lot of difference for the purpose of the final exam. So I encourage you to get a good calculator for the final exam. So what did you get in your bank reconciliation? The last line of your bank reconciliation, what balance do you have there? How much? So if you do your bank reconciliation, the last line would be this, right? Adjusted bank balance according to the general ledger. How much did you get there? Have you guys calculated? Let's try. Let's see. 28? 28,200. Okay, we'll see in a minute. Now, looking at the question, you can see that the bank balance, according to the bank statement, is 26,200. But the bank balance, according to the bank statement, is 34,631.80 cents. This is a huge difference. So you get your bank statement, and you see that in your bank statement you have $34,631.80. You look at your records, you only have 26,200. So clearly there has to be some discrepancy or difference somewhere that you have to explain. So let's start off with the bank reconciliation. Well, cash balance according to the bank statement, we have it. What do we do next? So remember that when we do our bank reconciliation, we are updating, essentially, our bank statement. In other words, we're looking for information that we recorded in our accounting records, but do not have in the bank statement, right? So what is the next step? What do we do next? What is the next line that we have to write? Yeah, so we have to deal with outstanding transactions. So transactions essentially that have not cleared with the bank yet. That's either a deposit or a check. So we have to add back any deposits that we might have in transit, and that's 4,600. And we need to take out any outstanding checks, and that's 12,570. Right? Is that correct? So where'd you get the difference from? So this is the bank, or this is the balance according, or that's what the balance should be according to our cash at bank ledger account. $26,660, right? If we go back to the question, we have deposits that are not reflected in the bank statement and checks that are not reflected in the bank statement, these two items, right? Now, you can have a look at the service charge and you can have a look at this error, but that's already in the bank statement. It's already in the bank statement, so we don't have to worry about it. It's in the numbers. In fact, we have to worry about this, but for the purpose of updating our cash ledger account, not the bank statement, right? I'll repeat myself again. That's how much cash we have in the bank account right now, right? That's the transaction that has not cleared with the bank account, or with the bank, and that's another transaction that has not cleared with the bank. This 4,600 will increase our bank statement value, but this one, 12,570.80 cents, will reduce it. So by doing the bank reconciliation, we add the deposits that have not cleared yet, but we also have to deduct any outstanding checks, and that's 12,570.80 cents. So that will give us a bank per cash at bank ledger account, or balance per cash at bank ledger account of $26,660, and that's a debit. In other words, that's how much money we should have recorded in our cash at bank ledger account. It should be 26,660. What is it right now? 26,200. So there's clearly a difference somewhere of 460. 26,200. Yes, $460. So the way we do the reconciliation is that we now have to start off with our cash at bank balance and then work our way through the adjustments to arrive, hopefully, at the same figure of $26,660. So the bank balance is $26,200 right now. What's happened with the error? There's an error, $1,560 and $800, right? So is that error in our favor or is it against us? Is it?
It's in our favor because bank will be debited by 760. We have paid more and the expense was less. So we have paid more.
Yeah, so, well, from the bank's point of view, everything is correct, right? The money is there. But from our point of view, we recorded an expense, we debited expense for 1,560, 1,560 debit the expense, right? And credit cash for 1,560, but it should have been 800 only, right? It should have been 800 only. So going back to the solution to the exercise that I talked about earlier today, we need to do a reversal of that transaction for the value of how much? Yeah, 760? Because the expense should be only $800. How do we get from $1,560 to $800? We reverse it by the difference of $760. So if we reverse it, we debit cash for $760 and credit the expense for $760. And so if we do that, then we clearly increase the asset, or we clearly increase our cash. So we add the check error of $760. What about $300 in the question? So maybe I can get your thoughts, guys, on this from this part of the room. So what do we do with $300? So if we go back to the question, right? Not very responsive. Okay. What do we do about this one? Service charge on bank statement not recorded in the books. What does that mean? Or what do we do with that $300? What are your thoughts? Add or, so, that's what you're talking about, less $300? Yeah, we have to deduct the $300 from it. So right now, after we added 760, we have 26,960. But the $300 we have in the bank statement as an expense, that's a bank charge, right? But we haven't recorded in our books, so we have to adjust for it. And so by deducting $300, we get to the exact same balance of $26,660. And so when we do our double entry, which is what the question is requiring us to do, is first of all, there are two entries there, right? We have to take care of the error first, and second, we have to take care of the $300 that wasn't included in our cash payment special journal, or cash payment special journal. So we do reversal, which we talked about. We debit cash and we credit our expense. Expenses normally have a debit balance, so if we credit them, we reduce them, right? The expense right now is $1,560. If we credit it by $760, the expense is going to be $800. Okay? And the second one is we just create an expense and credit cash. So if you look at these two transactions, the net effect on cash is increase of $460. So it goes from $26,200 by $460, $26,660. Okay. So now let's have a look at the steps in the reconciliation process. I mean, we've done it right now, right? But this was an easy question in the sense that if I go back to the actual question, the information was given to you, right? Opening balance given to you, the closing balance given to you for the bank statement. The closing balance according to your cash at bank ledger account has been given to you. Deposits not reflected, unpresented checks, everything has been given to you. You only need to plug in the numbers, which is relatively straightforward once you understand the process, right? But what we're going to be doing next is we're going to be going through the steps if you are given the financial information, like the prior period bank reconciliation, the bank statement, etc. Because in reality, if you're working in a company and you want, or in any business really, and you want to do a bank reconciliation, you're not going to be given this information. You will be presented with the statements. You have to use those statements to do the reconciliation, right? So what do we need to do the bank reconciliation? Well, we need to have 3 documents. The bank statement itself, since the previous bank reconciliation, meaning that the current bank statement. Then we need to have last bank reconciliation, because some items on the bank reconciliation, if I just go back quickly, let's have a look at this bank reconciliation. What if this deposit has not cleared? What if this outstanding check is not cleared? If they still have not cleared up until this period, we still have to carry them forward, right? Even if they have cleared, we still need to know that they have cleared so we can tick the boxes between the last period bank reconciliation and the current bank statement. And our records, essentially. All the cash payments and all the cash receipts. Then we need to match all the items between the 2 sources. On one hand, we need to have our bank statement. On the other, with all the transactions for the month. On the other hand, we need to have prior bank reconciliation as well as all the cash payments and all the cash receipts for that month for which we prepare in our bank reconciliation. For each item that is matched, we give it a tick, right? So what that means is that if we get a tick for an item on the bank statement and an item on the cash receipt, cash payment journal or prior period bank reconciliation, we're saying that for these items, records are consistent, right? We don't have to worry about it. The records are consistent. Make sure that the checks are numbered correctly, or the numbers correspond between the 2 different sources, because it's possible that you have 2 different expenses which are valued at the same, which have the same cost essentially, right? Or they have the same value. You really need to make sure that you tick the right one. The debit column on the bank statement relates to the cash payments, checks, and the credit column relates to the cash receipts, because from the bank's point of view, it's the other way around. The credit column is your cash, but for them it's a credit because it is a liability. Let's continue with the steps. So then we need to include in the cash journals any items without the tick that appear in the bank statement, right? Just like what we've done before. If you have some information in the bank statement that you don't have in your cash journals, cash receipt or cash payment, you must update that information, right? Via the double entry. Bank charges, interest paid, received, any dishonored checks that might be there. Then we need to circle any items in the cash journal as well as the last bank reconciliation statement that have not been ticked, right? So they represent items that are recorded by the entity but not on the bank statement. For example, and we've done that before, outstanding checks, deposits that might be in transit, and any errors that might be there as well. So items that have not been ticked, you have to circle them. Total the cash journal and post to the cash at bank general ledger at the end of the period with the updated numbers. And then prepare the new bank reconciliation statement with the items that you've circled in number 5. So if you have something in your cash journal and the last bank reconciliation that has not been circled, that means it now must be part of the new bank reconciliation. So if you circle those items, they're now part of the new bank reconciliation. Okay. Let's have a look at the question. I think maybe now would be a good time for us to have a short break. Let's have a 7-minute break now, okay? Because there's still a lot of stuff to go through. I'm not sure if I can, finish on time. We'll have a very long break. So I encourage you to quickly do what you need to do. Maybe grab yourself a drink or use the washroom, and then at about 6:37 we will continue. In the meantime, if you don't want to leave the room, then you can go through this kind of exercise here and have a look at it. At the end of class, I'll just wait for everybody to stay, because often what happens is students leave halfway through. I want everybody to stay and then tick your attendance.
Are here recorded in books? I'm very confused about in books.
In accounting records. So in basically your cash payment, cash receipt journal. So by books, we mean accounting records of a company.
Company.
Yeah, so not on the bank statement, but in the books, just like we did, remember the T ledger account? Double entry, that's what we mean by the books of a company.
Okay.
So where'd you get this translated from? You go ahead.
Thank you.
Okay. You're welcome. Yes.
Sorry.
No problem.
Yes,
It's a
I
similar
think-
story, right?
Yeah,
Which one is-
it's easy to understand. I don't know what mean is. So it's shipping expense. So
Yeah.
I expense $800.
Yeah,
But
yeah.
Bank.
Do you have a pen? I can write it out for you. Okay, thank you. Can I write somewhere
Yes.
here? Perfect. So basically what we've done, so it's an expense. We paid for it in cash. How do you record it? Debit what?
Debit cash.
Expense.
Debit
Shipping expense.
shipping expense. How much?
$8. 800.
Not exactly. Recorded at this amount.
Ah.
So recorded at this amount, right?
Yeah.
And then we credit our cash, right? For the same amount.
Yeah.
But now we realize that that's not the right amount.
Yeah.
It should have been recorded at 800. How do we fix this? How do we fix this? What would be our debit? What would be our credit? How do we fix this? How do we get from this to only 800 and 800? Yeah?
Shipping expense.
We have to reverse this. We have to flip it. So we have to debit cash.
For the
And-
difference between.
Correct.
Oh.
Shipping expense. So how much do we need to do it by? Right now, shipping expense is $15.60. It should be how much?
Difference between this one and $800.
It should be 800.
Yeah.
So right now it's this, it should be 800. How much do we need to reduce it by?
The difference.
Yes, which is 760, right?
Yeah.
So 760. So in our books right now, this is what we have. Instead of this, it should be 800. How do we get from this to 800? To get from this to 800, we need to reduce the shipping expense by crediting it. To get from a negative cash to a 1560 to this, we need to debit cash. So that's how we fix this problem. In the books, meaning that in our records. Yeah?
Not a bank.
Exactly.
Yeah.
Exactly. Sorry guys, I need to get back to the lecture.
Yeah.
Okay.
Thank you.
You're welcome. Okay, let's continue with our lecture. So, here is an example of bank reconciliation. Or, at least the information that has been given to us. Right, now here we have three documents, on this slide anyway. We have our bank reconciliation from the previous month, we have our bank statement for the current month, and if I quickly skip through this, we also have cash payments, cash receipts. So we have all the information that we need. Remember the steps, right? We need the information that we need, and then we can start ticking boxes. So if I go back to here, we need to start ticking boxes. And remember what we are comparing. We are comparing the information in the bank statement or in the statement that we received from the bank against prior month's bank reconciliation as well as our own accounting records. Right? So, in other words, we need to compare information that is here against what is here, and against what is on the next slide for you. Okay? So, remember, let's have a look at bank reconciliation from the previous month. We had the cash balance according to the statement. Then we had some deposits that had not cleared. We recorded those deposits, but they had not cleared yet. And there were a couple of checks here, 161 and 220, which had not cleared yet. So what we want to see this month is whether they have cleared. Have they cleared? Have they cleared? Yes, no, partially. Has any of the information coming from the previous month cleared now in our current bank statement? What has cleared? So, we put in a deposit that the bank didn't receive yet at the end of last month. There was a deposit there which had not cleared. Have we received it now? We have received it, right? This first deposit that was there from last month has now cleared. Remember, credit is an increase in our funds, because from the bank's point of view it's a liability, but from our point of view it's a cash inflow, right? What about outstanding checks, 161 and 220? Have they cleared now? All of them? So 161 has cleared, we give it a tick. You see, we're looking for consistencies. If they have cleared, we give them a tick. Okay? But the second one, 220, still hasn't cleared. So the customers that we've written the check out to, they have not claimed it yet. It hasn't cleared through the bank yet. So what does that mean? Well, it means that because it hasn't cleared here, we need to take this into the next bank reconciliation, right? It hasn't received a tick. Okay, we're done here with the prior month bank reconciliation. We've ticked 2, and we've circled another one that still needs to be in the current month bank reconciliation. Okay? Now, I'm not going to jump between slides because it's all animated, and I need to, for each tick, and then I need to go through the end and then get to the next slide. But you have the slide in front of you, right? So now you can basically tick everything in the debit column and the credit column. The debit column will be ticked against your cash payments. The credit column will be ticked against your cash receipt from the other slide. So let's have a look. That's how much we can tick, right? Make sure you go back to that slide and you tick those amounts as well, right? Because we're looking for consistencies. We're looking at what we have in the bank statement and what we have in our cash payment, cash receipt journal at this stage. And we have all those items. But there are a couple of items that we have in our bank statement, but we don't have in our cash receipt or cash payment. And those are relating to the charges. So the state duty, the federal duty, and the fee for the account totaled $9. And we also have the direct payment from the Citicorp. So that is going to be our, this $9 is going to be our expense, our payment. The $20 is going to be our receipt. And conveniently here, we're also saying which journal it would be recorded in. Cash payment journal, because we haven't recorded them, and these are payments, so these are expenses. And the other one goes into the cash receipt journal, $20, right? So now it's done. From the point of view of updating our cash receipt and cash payment journal, now we move on to this, or first of all, the cash receipt journal. We tick those ones. These would correspond to what we had on the previous slide in terms of the ticks. For example, 500, 1286, let's go back, 500, 1286, see ticks here? We also have ticks on the next slide there as well. The only thing that we have here that we don't have in our bank statement in terms of our cash receipts is the voucher of $52, right? We have it in our records, but that hasn't cleared with the bank yet. So that must be added into our bank reconciliation. So see, it says bank reconciliation. We ticked all of these ones, but we still have 4 checks that have not cleared. We've recorded them, but they have not cleared with the bank, right? Now we've done everything. We've accounted for every single item. The items that are in the bank statement that are not in our cash journals have been circled. Items that are in our cash journal, which are not cash journals, which are not in our bank statement, have been also circled. So we can now prepare our bank reconciliation and our entries, journal entries to reflect that. So let's start with the journal entries first. What is our starting balance? What is our starting balance according to our accounting records? What is the opening balance for our cash at bank account? Yeah, but what's the value of it? Can we see that anywhere here? Remember, last month or last period's closing cash balance is this period's opening cash balance. Now, these are all the transactions that happened during the period. They don't tell us what the opening balance was. But if we go back one step, can we see what the opening balance is? 4720. That is our opening balance, cash at bank opening balance that we had at the beginning of the period, that we had at the end of that we had at the end of July, and now we have in August, right? So we start off with that, 4,720. What are our total cash receipts? What are our total cash receipts? Can anybody tell me? What are our total cash receipts? Based on this slide. What are the total cash receipts? 343, right? Just down there, total cash receipts. But that's not the accurate number, right? Well, it's close to being accurate, but it's not exactly accurate because we have information in the bank statement that we don't have here. What should be our total cash receipts? What should be our total cash receipts? Minus what? Minus this one. But that's the correct number. It should stay here. No, it should stay here. So it shouldn't be minus 52. It should be recorded, but it hasn't. Well, I mean, if it's a cash receipt and it hasn't been recorded, then it should go in the bank later. But we're looking at the cash receipts from our point of view, from the point of view of a company. Plus 20, right? So $20 that we had in our cash at bank account is here, but we haven't recorded it in our records. It's there, but not in our records, right? That's why we made a note to ourselves that it has to go in the cash receipt journal, and we haven't done it yet, so we have to do it. So instead of having 3443, it should be 3463, right? And it's basically the balance of 3443 plus the $20 that we haven't recorded, and we have to do it now. We have to record the $20 now. What would be our total cash payments? What would be our total cash payments? So let's go back to our total cash payments. What are our total cash payments? 3,829. How much should it be? 3. Is it minus 9? Or is it plus 9? It's plus 9, right? So we basically, these expenses we haven't recorded, right? They are in the bank statement, but not in our records. So, in other words, we have this much, but it should be this much plus another $9. Okay, so 3,829 plus the $9 that we had. So now, with the running balance, we can actually calculate what the total balance should be after we receive this much cash and after we spend this much cash. So our cash balance at the end of the period should be 4,345. So now that we do our bank reconciliation, we should get the same number, right? So let's do our bank reconciliation. What is the bank balance according to the bank statement? How much money do we have at the end of August according to our bank statement? Let's go back. Let's have a look. How much money? How much? 4891. 4891, correct, right? That's how much money we have according to our bank account, or our bank statement, sorry. So we start off with 4891, okay, credit, because it's from the bank's point of view. What do we do next? What's the next thing that we need to do? Sorry? Yeah, we need to add deposits that are in transit that have not been cleared and deduct outstanding checks that have not cleared. What are our deposits in transit? Does anybody remember our deposits in transit? So let's go back to here. 52. Anything else? So we're talking about 52 over there. From the looks of it, I don't think there's anything else. It's just that one $52 voucher that has not cleared with the bank yet. Okay, so let's have a look. Yes, it's 52. What about our outstanding checks? What do we have there? Yeah, so we have 220. So let me go back again. Sorry, I keep skipping, going back and forth with the slides, but it's important to go back to the numbers and see where they're coming from. This has not cleared yet. We haven't ticked it. It has to be carried forward. But on top of that, we also have all these checks which are outstanding. So we have in total 5 checks. From the previous bank reconciliation, then $97, $16, $115, $115, right? So, and all of those, which would add up to 598. So the total now is going to be exactly 4345, according to our bank reconciliation. 4345, that's your opening balance plus deposits in transit minus all the outstanding checks. That's how much money you should have in your bank account, in your cash at bank ledger account, and that's exactly how much we have according to this calculation, 4345. Okay, so I think now we're ready to do this, to do the student exercise. So we have the following information, right, provided in the next slide. We need to prepare the cash at bank ledger account with the running balance. What we mean by running balance format is exactly this. You know how we did a T-ledger account, debit and credit only? This is a 3-column account where you have the account, the debit, the credit, and the balance. So this is what is referred to the running balance, meaning that after single transaction, you know what your balance is, right? So what you have to do now is basically cash at bank ledger account, the running balance, and the bank reconciliation statement. Exactly which we have just done. You need to do that now on your own, and you provided that information. The good thing about this exercise is that everything is on one slide. So I'll give you 5 minutes, a little bit less time this time. I'll give you 5 minutes to go through this, and you just follow the steps. You need to start ticking items that are both in your bank statement on one hand, and prior month bank reconciliation and the cash receipt and cash payment journals. And then circle items that are not either in your bank statement, that you have to then include in your bank reconciliation, or are not in your cash receipt, cash payment journal, which you have to update through a double entry, just like we've done in the previous question. So I'll give you until 7 p.m. and then we'll go through that exercise together. It's not about how quickly you can do it, it's more about the quality. So take it slowly, but make sure you understand the process and how you perform, or how you go through every single step. What we've covered previously, the steps in the bank reconciliation process. And again, if you have any questions, I'm happy to come around. Just raise your hand and I'm happy to help you out. Okay, let's have a look at the question in detail. So we have our bank reconciliation from the previous month. We have our bank statement on the right-hand side, and then we have our cash payments, cash receipts. What do we have to do first? Tick? Tick what? Yeah. Well, we have to start somewhere. So we need to start off with, normally, with the prime month bank reconciliation. And what we want to see, if the transactions that were there before in the prime month bank reconciliation, whether they have cleared by now. And by cleared, I mean whether they appear in our current bank statement, right? So let's start off with a deposit of $3,060.40. Has that cleared now? Yes. Okay, so we'll give it a tick. What about outstanding checks? Have those cleared now? Have those cleared now? 3961 has cleared. 1689 has cleared. 853.6, has that cleared? No. What do we do? Circle. Where does it go? Does it go in our cash payment or cash receipt, or does it go in this month bank reconciliation? Where does it go? Where does the $853.60 go? Where does that go? Current bank reconciliation, cash payment, cash receipt journal. Where does it go? Has that amount been recorded in our records? Has it been recorded? No? Or yes? If I'm asking you again, then that probably means a yes, right? It has been recorded. Now, it's here because it hasn't been recorded, it hasn't cleared through the bank, but it has been recorded in our bank statement, in our bank account before. In fact, it was recorded there in the previous month. But the problem is that it still hasn't cleared through the bank. I mean, look at so that's supposed to be a check, that's supposed to be a payment, hasn't come through. So we circle it, it needs to be in the current bank reconciliation. Okay? Then we move on to our cash receipt. So cash receipts journal would correspond to the credit column in the bank statement, right? Credit column. 4,421.40. Have we received that? Have we received that? We have. We'll give it a tick. 5150. We'll give it a tick. 5908. Yeah, there's an error, right? I mean, you can see that when you look at the deposit, you can see there is a 1-day delay. You record on the 12th, you receive it on the 13th. You record on the 3rd, you receive it on the 4th, yes. You record it on the 20th, you receive it on the 21st. So we assume that this 5890 is that payment, or does relate to 5908, but there's a transposition error, right? So here you have 5980, and here you have 5890. So the numbers have been swapped. And it's more likely to be an error in our records. I mean, it could be a bank's error as well. But I think the assumption here is that the bank's records are accurate, but our records actually are not accurate. So what does that mean? So if the bank records are accurate and our records are not accurate, what records are we adjusting? Are we adjusting the bank's record? So in other words, does this difference go into the bank reconciliation, or does it go into our records? Or the bank reconciliation? If the bank is right and we're wrong, where do we record it? Our records or bank reconciliation? What do you think? Our records or bank reconciliation? Bank? But the bank is right. So why do we need to change anything in the bank if the bank is right? Did I convince you otherwise? Or you still think it's the bank records? So the number in the bank, this number here, 5890, is correct. Right? But this number, 5908, is not correct. And that's in our records. So we have to adjust our records to fix the mistake. How much do we need to adjust our records by? So you look at this number, how much do we need to adjust our records by? How much? 18. Up or down? Up or down? But if we put it up, 5908 is going to be 5926. So it should be down. Okay. So we need to update our cash receipts journal down by $18, right? If we update it down by $18, we will get exactly 5890, just like we would have with the bank, consistent with the bank. What about 5672? Has that cleared? That hasn't cleared, right? 5672 has not cleared. So what that means is that because it hasn't cleared, that means we don't have it. Well, we don't have it in the bank statement, which means that we have to include it into our bank reconciliation for the current month. Okay. Let's continue. Let's have a look now at our payments. So payments would correspond to the debit column. Let's have a look at check number 115, cleared. 116, cleared. 176.40 has not cleared. So now it becomes an outstanding check for the purpose of bank reconciliation. Let's move on. 3500 has cleared. 2681 is another check which is not cleared. Circle it, part of our bank reconciliation. There are a couple of things now that we have in our bank statement that we don't have in our records, right? For example, 44. 44 is the charge, is the bank fees that the bank charged us, but we didn't record it. Because it's a payment, we need to update our cash payment journal. Okay, what else is there? 44214. So we recorded as a cash receipt, it came through, but now we have it here. Why? Yeah, so NSF is a non-sufficient funds. So the customer gave us a check, we went to a bank with the check, we give the check to the bank, they put the money in our bank account. We thought it cleared, but it turned out that the check was dishonored and the money came, well, it didn't come back, but there was a reversal of it. So now basically we don't have the money. So here's the problem. We recorded it as a receipt of $4,421.40, but turns out we actually don't have the money in the bank account. So what we have to do is we have to update our cash receipt journal. And you know, when you think about cash receipt, you think about adding the numbers, right? Because it's a receipt. You tend to receipt stuff, and therefore it should increase our cash receipt journal. But you will see error will reduce it, and the dishonored check will reduce it as well. So it's a bit maybe counterintuitive, but it's kind of like the reversal of the initial receipt of the money or the mistake that we made previously. The only other thing is our dividend, $1,000, right? Didn't record it, but it's there. And it's on the credit side, meaning that we received that dividend, so it must be part of our cash receipt journal as well. Okay, now we ticked everything. We've circled everything that we needed to circle, so we can move on to actually do our transactions. Now, if we go back here, we know what the total cash receipts were, $21,151.40. We know our total cash payments, $16,198.80. But we know that these now have to be updated, right? We know that, for example, the cash payment journal has to be increased by $44, and the cash receipt journal should be reduced by $18 here, and also the reversal of the dishonored check. Okay, so let's have a look. Now, if we go back to here, balance per cash at bank ledger account, that's our closing balance for May, opening balance for June. That's what we have to work with at the beginning. So it's $21,292.60. That's what we start with. Then we have our total cash receipts, right? It's $21,151.40, which what we had originally, the total for the cash receipt. But there was a dishonored check, which we're now taking out, and there is also an error. In addition to that, we have a dividend, which we didn't recognize in our records, right? And then we have a cash payment. What do we have here? We have the original balance plus the fee that we didn't have before. And so what that means is that our balance at the end should be $22,761.80. That's what our balance should be. We can confirm that by doing a bank reconciliation. Let's have a look. We're starting off with the cash balance per the bank statement. And again, if we go back to here, it's $21,700.80. That's what it should be. Well, that's what we have in our bank statement. Let's have a look. We're starting off with $21,780. Then we need to add any deposits that are in transit. Did we have any deposits? 5672. Okay. So that's a credit balance. So 5672 is what we had in the cash receipt journal but didn't have in the bank statement. What about outstanding checks? So these two have to be in that column, but it doesn't matter. This is just the total. Now, 85360 is coming from the previous bank reconciliation. So if I go back all the way to the previous bank reconciliation that we had before, that 85360 is what's coming from the previous bank reconciliation. We have to account for it now as well. On top of it, we also have outstanding checks, 1076.40 and then 2681, right? So we have 1076.40, 2681. It's a total of $4,611. So now we have the total here minus $4,611. We get balance per cash at bank ledger account. That's what it should be based on the bank reconciliation. It's $22,761.80. So if we go back to here, that's exactly what we had, right? $22,761.80. Okay. Whew, that was bank reconciliation. Okay. Do you have any questions before we continue with the petty cash? Petty cash is not going to take a long time, but the budgets will take some time, and I want to get onto the budgets, cash budgets. Okay. So funds, petty cash is funds that is used for making small payments that are not practical to you, for staff or employees of a company to write out checks for. For example, taxi fares, coffee, and tea, stationery, etc. Right? So cash is drawn from the company's bank account and placed in a petty cash box, kept securely and controlled by an authorized individual. In other words, you take cash from your cash at bank account, put that in the box for other stuff to use, right? So makes it a lot more convenient if they need cash for small expenses that are regular in nature, sort of. Payment from petty cash must be accompanied by a petty cash voucher and a third-party receipt where possible for auditing purposes, right? Again, if I am the one who's got the key to the petty cash and you're a friend of mine and you're one of the employees and I just give you the money, that's not appropriate, right? There's no separation of duties, or there's no clear effective record of what's actually, or how the money actually has been spent. If you have a third-party receipt, then it would at least show that there was indeed an expense. Fund will be replenished by the total amount that has been spent. So, how do we set up petty cash? Well, when we set it up, we simply debit petty cash and we credit cash. So, in other words, what we do is we take one asset, reduce it to create another asset. So, once you set up petty cash, your total cash position actually doesn't change, right? But you now created a separate account. When you do use it, you debit the expense and you credit your cash. And this is where a lot of students get really confused. So if we create petty cash, why don't we credit petty cash, right? Why do we have to credit cash? We'll see in a minute why that's the case. So here is an example. So Red Limited established a petty cash fund of $300 on 1st of December. The disbursements were made during December as follows. And then reimbursement checks were drawn on the 16th of December and the 31st of December to replenish the petty cash account. So we need to prepare journal entries to record the establishment and replenishment of the funds in the petty cash account. So in here we have a bunch of expenses for the month of December. So we had taxi fares, we had staff tea, supplies, fares, postages, stationery, etc. Right? Had a bunch of different expenses. We can combine them all together and to make it easy for us in terms of the recording of the entry. So we need to first establish the petty cash. It's $300 on 1st of December. What is your double entry? Yeah, debit petty cash, credit cash. Okay, that's fine. We can do that. Petty cash, cash. Now, when we record those disbursements, in other words, when we record actual expenses that have been consumed, we debit the expenses, right? Travel expenses, office expenses, all together, and we credit our cash. So then the question is, well, if we established petty cash, why do we credit cash? Why don't we just credit petty cash? Because we're taking the money from the petty cash. So let's say we have a box of $300, right? A physical box, we have $300 in the box. You take money from the box. The money is clearly not in the box anymore. Why don't we credit the money in the box if the money leaves the box? So that's where students get confused, because they think, well, if you take the money from the box, why don't we credit petty cash? Why do we credit cash? Why? No, it's not. No, it's not.
We are taking 300 out of cash to make a new account for petty cash so that we can have all the journal entries, small journal entries, small payments from that petty cash account.
Yeah, we do have that in reality. Money is being taken from that box, right? But we don't credit it. The reason we don't credit it is that, well, it needs to be replenished. So if you credit it, it goes down from 300 by 69, for example. Then, to get it back to 300, you need to debit it by the same amount. So you credit it and then you debit it. If you credit cash, your petty cash never changes, which means that the assumption is that it's always replenished after the transaction, right? So that's the idea. If we don't credit it, we assume that there's always $300 in the petty cash account, and it saves us the other entry, which is if you credit petty cash, you have to debit it again to bring it back to $300. We don't have to. We establish it once according to the accounting entry anyway, and we never touch it again. It's always there, $300, and then we just credit our cash. I think
Money from cash account to make a petty cash account, then we don't use it.
Well, there are two things. From the practical point of view, we do use petty cash, right? From the accounting point of view, you can think of, well, there is a petty cash account out there, but ultimately it's cash. So it's taken from the cash account, right? It's just that, so then the question is, so why do we even create it like this? But we want to see how much money is in the box, how much money has been allocated there at any time, supposed to be there, right? So if you don't have it, then you look at your records and you say, well, there's no box, there's no petty cash, but there is actually some. I mean, presumably, it's not going to be that material, right? If you're a large company and in the box you have a couple $1,000s, it's nothing. And you will also talk about the concept of materiality, I'm sure, when you do auditing, and maybe some other accounting units. But materiality does not have to be by quantity, it could be by quality. So even if you have small petty cash, but the money is lost, it's not material quantitatively, but it is material qualitatively because somebody is still in the money in your company, right? Something that you might want to investigate. And so continuing off with other expenses, we credit cash there as well. right? Because ultimately it's cash that is going to be reduced, right? And we just always keep petty cash there available to us or to pay from.
We are not, reducing cash twice actually, for making petty cash account, we are reducing cash by 300, and now for deducting all the expenses payment, we are reducing cash again. So that's
We're reducing cash. We would reduce it twice if we didn't have petty cash as a debit, but we do. So ultimately, in terms of debits and credits, there are no double entries, right? There are no problems with double entries because when you prepare financial statements, you don't really have petty cash there. You just have cash. And so how do you have cash? To your total cash, you just add whatever you have in your petty cash. So that takes care of the double entry or double spending problem. Okay. So the next thing that we need to talk about, and the last thing that we need to talk about today is budgets, right? And that's an important topic. So what is a budget? Well, it's a detailed plan showing all the expected sources and uses of cash. In terms of the cash budget, right? You can do budgeted income statement, you can do budgeted purchases schedule, you can do budgeted balance sheet, etc. We're only talking about the cash budget today. So the major inputs are the schedule of cash receipts and cash payments. So basically, if you look at the cash flow statement, what do you have? You have your if you look at activities, operating, finance, or operating, investing, financing activities, for each activity you have inflow and outflow, right? So when you look at cash, it's all about inflows and outflows to calculate the net cash position at the end of a particular period, right? So the major inputs are receipts from cash sales or from customers for credit sales. And the payments, of course, would be payments to suppliers for inventory that you purchased either in cash or on credit, plus other expenses. And always remember that cash budget would be very different from the income statement, right? Even though it's expenses and revenues, but the cash budget might have non-current asset investments, for example. Whereas income statement would have expenses such as depreciation, which are not cash related. So separated from the budgeted income statement. The expected movement of cash does not equal expected profitability because of that, right? In the income statement, you have depreciation expenses that are not cash. So cash would be higher. If everything else is constant, cash position would be higher than your income statement. But in cash, you would have expenditure on non-current assets. You purchased equipment, right? You spend cash, but that would have no effect on the income statement until later on when you depreciate the asset. Cash budget ignores depreciation, for example, right? So why is it important? Well, I touched on this a little bit, and I said, well, we prepare financial statements based on accrual accounting, but companies, asset is a vital asset. We talked about it earlier today, right? So companies do want to know how much cash they expect to have at the end of each period later on. Projected cash position, let's say every single month for the next quarter or for the next 12 months, right? It helps management to to do planning for the borrowings that they might have to have if they have some cash deficiencies, or they may want to, if they have enough cash, projected cash into the future, they may want to start repaying their loan, or they might want to invest in some shares in another company to generate them some additional profit, right? So it also makes sure that firms have adequate cash balance to take advantage of cash discounts. Let's say your customer comes to you, or your supplier comes to you, not customer, supplier, and the supplier says, look, if you buy this much inventory from us now with cash, we'll give you a 20% discount, for example, right? They want cash, they give you a 20% discount. If you have cash, you can take advantage of it. Or, if there is to maintain credit ratings or comply with loan covenant, which we talked about previously, or if there is a good business opportunity. Let's say you can invest in a project, but you need cash for it. And the project can be very lucrative. If you don't have cash, you can't do it. Meet emergencies, natural disasters, strikes, etc. So that might be handy, having in cash to do it. So what are the sections, what are the main sections of the cash budget? So, of course, we have the opening cash balance, right? The opening cash balance is how much cash you had at the end of the last period. last period's ending cash is this period's opening cash. Then we have all the cash collections, cash sales, credit receipts, cash receipts from credit customers would add up to, would make up our cash collections. And then we have all the cash disbursements or cash payments or cash outlays, whatever you want to call them, except for the interest payments, because we would record those separately. Because we want to see really what our deficiencies or surpluses in cash are for us to either pay out or borrow more money. So interest payments and short-term loans will be recorded in the net later. So all expenses not resulting in cash outlets are excluded from the list, for example, depreciation. Okay, so that will give us, so the opening balance plus all the cash collections minus all the cash payments will give us the available cash, right? We either have excess cash or we have deficient cash. So we have surplus cash or deficient cash. If we have deficient cash, that means that the cash available is less than the cash need. So you don't have enough cash to pay for your expenses and outlays or expenditures, disbursements. Excess cash is the opposite. Your cash available is more than what you need. You can repay a loan, or you can make a temporary investment, or you can use it in any other way. And that will determine whether you are going to either borrow more money, right, or you can repay the loan, or in fact you can make that short-term investment or temporary investment and generate some interest or pay the loan that you might have. Okay, so if the bank allows you, you can go into the bank overdraft. So in other words, the credit balance on your bank statement becomes a debit balance, and you now owe money to the bank. From the bank's point of view, it's an asset, but the bank may not allow that to happen. And that will determine your ending cash balance, which will then become your opening cash balance in the following period. So let's have a look at an exercise. So Jonathan Proprietary Limited makes all sales on credit. Typically, we have 30% of credit sales collected in cash in the month of sale. Okay, and then the remaining 70% in the following month, or in the month following the sale. So the business opening balance for accounts receivables is $60. What that means is that we expect to collect $60 in cash this month, right? And this month, by this month we mean July, right? Because the end of the financial year was 30th of June, and the closing balance there was $60,000. That means the opening balance on the 1st of July is $60,000, and that's how much we expect to collect in cash in this month, coming from June. So what we need to do is to calculate the cash receipts for the 3 months ended 30th of September 2016. How do we do it? So what would be our calculation? In the table, we have our sales, right? July, $100,000 of sales. We know that these sales are all on credit. We know that 30% of credit sales are collected in cash in the month of sale and 70% in the following month. So how much are we expected to collect in cash in July for July sales? How much are we going to collect? 30,000, 70,000, 60,000? We are going to collect 30% of this. These are all credit sales. 30% of these credit sales are going to be collected in the month of sale. The month of sale is July. 30% is going to be collected in July. 30% of 100,000 is going to be 30,000, plus 60,000 coming from the previous month. What about August? How much are we going to collect in August? So in August, we're going to collect 30% from August sales, right? Which would be 36,000. Plus, we're also going to collect 70% from the previous month's sales, which is going to be 70,000. So 70 plus 36, 106, and so on. So let's have a look. In July, we're collecting 30,000, being 30% of 100,000, right? In August, it's 36,000, 30% of 120,000. In September, it's 33,000, 30% of 110,000. And then we have a total for the whole quarter, because we need to do it for the first quarter. In July, for the following month, for July, that's going to be June, and that's going to be 60,000. The opening balance of accounts receivables is going to be collected in full, 60,000. In August, we're collecting, yes, 70% of what we had in July. So that is 70,000. And there's a convenient arrow for us to show how it relates to the previous month. And it's the same thing with September. We're collecting 70% of credit sales in August. So 70% of 120,000 is going to be 84,000. And then we get the total for the first quarter, and then we can calculate our total budget for July, August, September, and for the quarter. Okay? So the next thing that we need to do is, so that gives us an idea of what the budgeted cash receipts are going to be for the first quarter, July, August, and September. Then we're provided with this information. So the company's cost of goods sold is 65% of sales revenue, and the payment to suppliers is equal to the amount of the cost of goods sold. So, I mean, we're selling products to our customers, but we need to buy those products as well, right? So the cost of goods sold is 65% of the sales revenue, and that's how much we pay to our suppliers in the month when we purchase these products from the suppliers, right? So Jonathan has monthly fixed costs of rent, $5,000 monthly, which means every single month it's $5,000. $3,000 of wages. Sorry, rent is $5,000, right? Rent is $5,000, insurance is $3,000, wages is $2,000, and depreciation is $4,000. Now, it does say monthly, which means every single month we have these expenses. We have rent, we have insurance, we have wages, we have depreciation every single month. So that must be part of our cash payment journal every single month. In addition, Jonathan pays a 7% commission on sales, and this is paid in the month following the month in which it is earned. So does everybody know what the sales commission is? So a sales commission is when a salesperson gets an additional bonus when they meet a certain threshold. Well, in this case, it's for every dollar that they sell, they get an additional 7 cents, right? So from the company's point of view, it's a payment. So it's an addition to the wages that we pay to our staff. And here it's interesting because it is delayed by 1 month. So the 7% commission on sale is paid the month following the month in which it is earned. So if employees earn $10,000 worth of commission in July, we pay that in cash in August. Okay? Now, we need to know what the sales commission was coming into July. So we want to know how much it was at the end of June, and we're given that information. It was $7,000. So that means that's what we have to pay in July. If that's how much it was in June, and there is a 1 month delay, that's how much we have to pay in cash in July. And for all other ones, you can calculate them because they're based on the sales figures, and we do know the sales figures. Okay? We have a little bit of time. I'll give you 5 minutes to go through this question and put this in this table. So we have a table where we have payments to inventory suppliers, payments for rent, insurance, wages. Think about depreciation, whether you need to include depreciation, payment of sales commission, and total budgeted cash payments there. So I'll give you a couple of minutes, maybe 5 minutes or so. Try to fill in this table. And don't forget that some payments will be affected by the delayed effect, right? They don't happen in the same month. For example, sales commission is delayed by 1 month. Where are the lecture slides? Where are the lecture slides? Did you calculate the total budget payments? Did you get the number here? Okay, let's have a look at it. Has anybody calculated total budgeted cash payments for July? 84,000? Has anybody else calculated and can confirm that it's 84,000, or have you calculated and you got a different number? Have you done the calculation, guys? Girls? You are in the process of calculating? Okay, let's do it together and have a look at whether what you've been doing up until now is consistent with the solution. So first of all, we need to calculate payments to suppliers. 65% of sales, $65,000. And that's what we get for August, okay? And that's what we get for September. It's just basically 65% of the projected sales in that month. We know payment of rent is $5,000 for each month. Insurance is going to be $3,000. Wages is going to be $2,000. What about depreciation? Do we include depreciation here? Yes? No? Do we include depreciation here? What do you guys think? What's the 50-50? It's either we include depreciation or we don't. Do we include depreciation in the cash payment projection? It's an expense. Do we include depreciation? Should we include depreciation here? So here we have cash payment projections. Do we include depreciation? Why not? No is the correct answer. Why not? Well, it's a non-cash expense, right? So if you buy a laptop, let's say you bought a laptop, you spent $1,000 on a laptop. A year later, you're not going to sell it for $1,000, right? If you've been using it. It would have depreciated by then. Maybe it's gone down in value by $300. Now, depreciation is a way to reflect the fact that the asset has contributed to generation of revenue of some sort, right? If we're talking about a business. So it would have depreciated in value, and but there is no external transaction. Remember, depreciation is a balance day adjustment, and with balance day adjustments, there are no external transactions. So there's definitely no cash. And remember the slide for balance day adjustments. Never ever does cash is affected or is cash affected when we record our balance day adjustment. So there won't be any cash. The sales commission was given to us, coming from the previous month, $7,000. How much is it going to be in August? 7,000, because it's 7% of the previous month's sales, right? 7,000, 8,400, because it's 70% of 120,000, and that's a total of 22,400. Okay, now we can total this together. You said 84,000? So 75, 82, right? 82,000, 95,000, 89,000, 266,900. Okay. Let me have a look. 76, 79, 81, 89,000. I think there's a mistake here, right? This should be 89,900. Yeah, okay, just imagine that it's not there, and instead of the 0, we have a 9. So 89,900. I had a class yesterday, I didn't pick it up then. So, but anyway, that's the total for the whole quarter, right? So what we need to do next is basically combine these two schedules together. So we had total cash receipts, we now have total cash payments. In addition to that, we know that the opening cash balance is 5,000, and we know that at the end of the period, if you have excess cash, you can earn 12% interest on it. If you have a cash deficit, it's the interest that you have to pay. Okay? So let's go through it together. What is our opening cash balance? July, 5,000 given to us in the question. Does anybody remember cash receipts for July? We did it a couple of slides ago. How much was that? How much was our total projected cash receipt for the month of July? So let's go back and have a look. 90,000, right? 90,000 is the total budgeted cash receipts for the month of July. So we have opening 5,000, we have receipts of 90,000, plus we have expenses of 82,000. So 90 plus 5, 95, 82, right? That's the expenses. So that gives us $13,000 on which we can earn the 12% interest. So let's have a look. 13,000, we can earn 12% interest on it. So, I mean, it's not really realistic, right? I wish we could have 12% interest monthly, not yearly, monthly. That would be amazing. That's 1,560. So at the end of the period, we have 14,560, which becomes our opening balance in August, right? Because closing balance in July becomes our opening balance in August. And we have cash receipts in August of 106,000. Cash payments were 95,000. So that gives us excess cash of 25,560, on which we can earn another 12%, which is going to be 3,067. And that gives us a closing cash balance of $28,627, which now becomes our opening balance in September. Cash receipts in September, 117,000. Cash payments, 89,000. Well, here it's correct, right? 89,900. Before it was just 89,000. There was an error. I told you about it. But 89,900, so that's correct. 55,727. That is our total excess cash, on which we can earn 12%, which is $6,687, and that gives us a total closing balance of 62,414. So we've budgeted for the first quarter of the new financial year, right? So we can expect that in July, that's how much cash we're going to have, in August and in September, and you can see that the business is doing pretty well, or is projected or is expected to do pretty well. It generates enough cash to cover the expenses, and it keeps on accumulating cash and earning some additional interest that really helps. So what does that mean? Well, if a company wants to expand the business, they, in September, if they want to buy equipment, they can do that because they're expected to have quite a bit of cash available for them to do it. So what if the question says the owner of the business withdraws $1,000 every month? Is it going to be here? If the question says the owner of the business withdraws $1,000 every month from the business, is it going to be here? Well, the double entry, yes. So is it going to be here? We're not recording the double entry here, but we're only interested in cash. So it must be here. The cash has been withdrawn from the business. It must be here. What if the question says the owner withdraws $500 worth of inventory? Is it going to be here? Let's say the owner has a lot of friends, a big family. The owner withdraws every month $500 worth of inventory. Let's say it's some clothes. It's a clothes business, apparel store. The owner withdraws $500 worth of inventory every month. Is it going to be here? No, there is no cash. It can't be there. There's no cash, right? Just be very careful with those type of questions. And again, we don't have any depreciation. Anyway, going through those expenses, we can do the same for the quarter as well. And of course, we'll arrive at the same number, but it's just that these numbers have been kind of combined into one column now. Okay, are there any questions? We've covered a lot today, and really, students come to me and they ask me, well, how do I prepare for the final exam and all that? The best way to do it is to practice. This is the accounting unit where you have to practice to really be good at it. And next trimester, I'm the unit chair for the unit, and you don't want to see me, and I don't want you to see you, meaning that I want everybody to pass and do really well in the unit. Okay? So please practice as much as possible and as much as you feel is required to make sure that you are comfortable with this type of questions. If you don't do bank reconciliation, let me just go back to it. If you don't do bank reconciliation and you go to the final exam and you see this, under time pressure, you may really feel stressed, okay? You look at this and you go blank. I've studied for 9 years, okay? I did a lot of studies, I sat a lot of exams, and it happens from time to time. You go into the final exam, you sit there, and all of a sudden you go like, oh, what am I supposed to do here, right? For that not to happen, please do make sure that you practice these questions, right? And you don't practice this question 1 week before the exam. It doesn't work that way, right? Usually, anyway. It doesn't work that way. Make sure that you do enough practicing throughout the trimester. And when it comes down for the preparation for the final exam, you just revise those questions in your memory, but you do know how to do them. Okay? Remembering all those steps, the only way you can remember the steps, the only way you can know how to do your double entries, the only way you can know how to do your adjusting entries is if you practiced enough. That's simple, right? The most important thing in accounting, from my experience, teaching accounting and studying accounting myself, is commitment, right? You may be really talented, really smart, you might have done accounting before, but you really, regardless of that, you need to stay committed. And if you've never done accounting before, students think, oh, well, I'm going to fail. No, if you stay committed, I had so many students, I teach undergraduate accounting and I teach postgraduate accounting. I had so many students who've never done accounting before, but they really keep at it, stay committed, and they get HDs. Okay, so that's just my little advice for you. Now for next week, when Raymond comes back in, please do make sure that you prepare this, okay? Please do read the case, because the case will be discussed at the beginning of next class, okay? All right, if you don't have any questions, thank you very much for coming. I have your attendance sheet here, so if you can mark your attendance, that would be great. And I'll pass it on to Raymond in the next class. Thank you. Okay, did everyone sign the attendance?